I own gold not because I think it's going to go through 2000, but because I'm afraid it's going to go through 8 or 9,000. And I feel the same about the price action that we've seen in silver. I don't think we're seeing a silver breakout yet. In my experience, precious metals bull markets are led by gold. Then the money moves to the gold stocks. And then when that price momentum attracts the generalist investors, which it only has for the last 13 or 14 weeks, eventually leadership goes to silver. I think it's a probability as opposed to a possibility that we get a silver bull market, a silver breakout.
Veteran natural resources investor Rick Rule has built a reputation over decades for his contrarian insights and deep understanding of precious metals markets. His latest predictions for gold paint a striking picture of potential transformation in the global monetary landscape, where current gold prices may represent merely the beginning of a much larger story. Rick Rule views gold as protection against major economic disruption, not as a short-term trade. He dismisses minor price moves as noise, holding gold not for a rise to $2,000, but in anticipation it could surge to $8,000 or $9,000 amid severe financial risks. Gold could rise by $4,000 to $5,000 in the medium term and possibly reach $8,900 by 2030, marking one of the largest wealth transfers in modern history, surpassing past precious metals bull markets. Central to Rule's thesis is his stark warning about the US dollar's future purchasing power. He predicts the dollar could lose up to 75% of its value over the next decade, not in relative terms against other currencies, but in absolute purchasing power. This distinction is crucial as it suggests a broad-based erosion of monetary value, rather than simple currency competition. Current data already supports concerns about dollar erosion. The purchasing power of the consumer dollar currently stands at 31.10, reflecting a 0.32% decline from the previous month, and a more significant 2.20% drop from 1 year ago. This steady deterioration highlights ongoing inflation pressures and demonstrates the gradual but persistent weakening of dollar value over time. Rule's investment strategy acknowledges the fundamental relationship between gold and the dollar. Gold typically moves inversely to both the US dollar and US Treasuries, which serve as key reserve and safe haven assets in the global financial system. When the dollar weakens, gold often gains strength, providing both a hedge against currency devaluation and portfolio diversification during uncertain economic periods. Before we dive in, make sure to subscribe, hit the bell icon, and share this video. Your support helps us continue bringing you sharp insights on gold, silver, and the financial markets.
In terms of what we're seeing in the last week, from my viewpoint, this is all staccato. This is all noise. In a different prior interview, when you and I were together, you were mentioning some of your listeners, probably younger listeners, concern about would the gold price ever get through 2000? I don't know if you remember this. And I remember saying to you, you know, Chris, a $200 gold move in gold is of no interest to me. I couldn't care less. I own gold not because I think it's going to go through 2000, but because I'm afraid it's going to go through 8 or 9,000. And I feel the same about the price action that we've seen in silver. I don't think we're seeing a silver breakout yet. In my experience, precious metals bull markets are led by gold. Then the money moves to the gold stocks. And then when that price momentum attracts the generalist investors, which it only has for the last 13 or 14 weeks, eventually leadership goes to silver. When leadership goes to silver, you're not going to need some old fat bald guy, Rick Rule, to tell you that leadership has transitioned. I've watched 3 silver bull markets in my life, and they are nothing if not dramatic. You won't be talking about a move from 34 to 36 or 7 and back. You're not going to be talking about dollar moves. You're going to be talking about lock limit up. Let's get that one straight. Yeah, people are interested in dollar moves. They're interested in intraday moving averages and stuff like that, I think, to amuse themselves. I'm interested in quantum moves, which require more time. What I do believe is that the US dollar as a measure of liquidity will outperform the US Treasury as a store of value. I believe in an absolute sense that, not relative to other fiat currencies, but in an absolute sense, that the US dollar will lose something like 75% of its absolute purchasing power in the next 10 years. We saw this in the decade of the 70s, and I think I can back up arithmetically why that's much more likely to happen. The consequence of that is that although gold will not replace the US dollar either completely as a store of value and as a medium of exchange, that the increase in the gold price should be at least concomitant or proportional to the decrease in the purchasing power of the US dollar. For gold bugs to be happy, you don't need the obliteration of the US dollar, and you're not going to get it. Did you know? I think you probably do, Chris, because you study this. In the most recent estimate by JP Morgan Chase, the market share of gold and precious metal securities relative to other asset classes was only 0.5%. The 4-decade mean was 2%. And according to JP Morgan Chase, they admit to not having statistics going back that far, but they estimate in 1981, the sort of nadir of the gold bull market, that the market share of precious metals and precious metals related securities relative to other asset classes was between 6 and 8%. I'm not suggesting that we take out our old high market share, but I'm suggesting that demand reverts to mean. Imagine what happens, given that price movements take place in just part of the value chain, if we increase demand for precious metals fourfold. That's what I think is going to happen.
Seasoned investor Rick Rule maintains a strongly bullish stance on silver, viewing the white metal as a cornerstone of his long-term investment strategy. His perspective emphasizes fundamental value over short-term price fluctuations, positioning for substantial gains that may exceed current market expectations. Rule sharply criticizes the investment community's short-term focus on silver. He argues that speculators chasing 50-cent price movements are missing the broader opportunity, failing to recognize silver's true potential for patient, long-term investors. This myopic approach creates market inefficiencies that sophisticated investors can exploit. The technical picture currently supports Rule's optimism. Silver demonstrates resilience by holding above key support at $33.68, while maintaining strength above $37. This price action establishes a solid foundation for upward movement. A breakout above $39.33 could open the path toward the next resistance level near $44.18. Macroeconomic conditions present favorable tailwinds for silver. In a bullish scenario driven by easing U.S.-China tensions and dovish Federal Reserve policy, silver could potentially revisit or surpass previous highs. Such conditions would benefit silver through both its industrial demand characteristics and monetary metal properties. Let's get back to the interview.
There is more silver that trades in the futures market by far on a daily basis than is around for good delivery in a quarter. There are some days where the futures market trades 200 times the amount of silver available for good delivery. These things cash settle. It's important to know that. If they don't cash settle, what happens is that the market gets halted, and then the exchange forces a cash settlement at their price. But if you're looking for a place that a silver squeeze takes place, it's in the over-leveraged nature of the futures market. There are a lot of speculators who require immediate gratification. They carry about a 50-cent move in silver, and they actually believe that there is going to be a physical squeeze in silver that will force the institutions into the market in a big way. That won't happen. The futures exchanges operate in their own interest, in the interest of the dealers. If there is an ugly, ugly, ugly silver squeeze, which I think they could be, they will do what they do with the tin market. They will halt the market and they will cash settle at a level they choose. You mean they'll screw their customers? Of course they will. That doesn't mean that there isn't a boatload of money to be made in the silver business. I've been around this business for a very long time. And a silver bull market is truly a wonderful thing to behold. But don't tell yourself, don't set an artificial timeline. Don't say, oh, for sure it has to happen by Thanksgiving. Why? The silver market doesn't care about your time preference at all. The silver market doesn't care about the stop date, the start date. They don't care. But in my experience, I've been through 3 silver bull markets. The first one was a 30-bagger, and the next 2 were each 10-baggers. Do I really care if it takes 2 years to get there, 3 years to get there? Put any discount you want in terms of the time value of money. Never mind a 10-bagger, a 3-bagger pays you a lot of rent. And I think it's a probability as opposed to a possibility that we get a silver bull market, a silver breakout. Silver mines are a fairly small component to silver production.
Right.
The lowest cost production of silver is as an adjunct of mining for other metals. And it's important to remember in terms of the cost structure that silver miners pay to mine silver, but copper miners don't. They get it effectively for free out of the product stream. The other thing is that we do not know, and we have never known, what the above ground supplies of silver are. What we do know is that high silver prices that are sustained brings that supply out. If you have a sense of history, you will remember back to the point in time when none other than Warren Buffett, who regards precious metals as pet rocks, bought between 15 and 20% of the world's reported above ground supplies of silver. And that imprimatur caused the silver market to go absolutely crazy. And 8, 9, 12, 15 months, something like that, all of a sudden the market got whacked.
Gold and silver continue to stand as critical anchors in an increasingly unstable financial landscape. While gold offers long-term protection against currency debasement and economic disruption, silver presents a unique opportunity with its dual role as both a monetary and industrial asset. The imbalance between paper trading and physical availability, particularly in silver, underscores the fragility of current market structures. What do you think will drive the next big move in gold and silver? Central banks, inflation, or something else? Let us know in the comments below. If you found this insight valuable, don't forget to like, share, and subscribe for more updates. Thanks for watching.